Hi, everybody. Thank you for joining us today to review a new service offering we have, or at least a revamped service offering to help you manage your employer-sponsored retirement account. We call this service our Retirement Account Management, or RAM service for short. So I'll be providing an overview of that today. And it probably will take me about 20 or 30 minutes, I think, to go through this presentation. Feel free to ask questions along the way. There should be a little chat feature on the bottom of your screen that you can type a question, and we'll try to field those. Christina, our marketing director, is on this call as well, and so she'll be trying to field your questions. And then at the end, there's also some time that we can answer your questions as well. So we will go ahead and get started. Just a little bit about our company. We are a fee-only financial planning firm located in Des Moines, Iowa. Des Moines is our only location. We've been here since 1997, so been in business for over 25 years. Started by John Severson and David Strege is where we get our name from. We are fee only, which means we only collect fees directly from our clients and do not sell any products or get any kickbacks on any product sales. We are fiduciary, so we're held to the highest legal standard and must act in the best interests of our clients. We serve about 500 families here in Iowa, in the Midwest mostly, but we are located in several states across the country. As of today, or at least as of the end of the year, we manage about 785 million in assets to kind of give you the scope of our business. Our investment committee is featured here. Myself, I am on the right side of this picture. I think I introduced myself. I'm Jason Gunkel, and I'm a financial planner and lead our investment committee. And this team here, we're responsible for services such as this type of investment service, where we conduct the due diligence and do all the monitoring for our investment strategies. And we assist our financial planning teams in implementing the strategies that they are discussing with their clients. And so we meet at least monthly to review all of our current strategies and also do due diligence on potential offerings as well. So let's provide a little bit of an overview for employer-sponsored retirement plans. 401k accounts are the largest type of this plan, and they might make up a large percentage of people's wealth. According to one study done by Empower, 401k plans make up nearly 55% of the wealth of high net worth individuals. In this study, a high net worth individual is considered somebody who has at least 1 million in liquid assets. And these plans, most employees can defer their salary into the plan, and many employers will provide matching contributions. And so over time, of course, this becomes one of their primary retirement savings vehicles and can grow to a significant value. Another study that was done by JP Morgan in 2021 found that over 60% of investors are looking for more help with their retirement accounts. And so with these 401k plans, often the participants are kind of left on their own to make the decisions. They're often given a list of investment options that they have to pick from, and they have to do most of this work on their own. And for many, it's really not maybe one of their main interests. It's not their main specialty. And so it's not a big surprise that many investors would be looking for more help with their retirement plans. Let's look at a few reasons here why investors or employer-sponsored participants might struggle managing their own investments. First, we know that investing can be emotional. And so the market these days is very volatile, and we have very good years. Last year turned out to be a very good year. In 2022, the market struggled. And so we're kind of on this roller coaster ride of up and down markets. And when the markets are doing well, people like to throw money into the stock market with the hopes that it continues to go up. On the other hand, when the market is doing poorly, people get quite fearful. And, being one of the main retirement assets, people don't like to see their 401k account values go down. And they might get nervous, pull their money out of the stock market, maybe move it into a cash position until the markets start to recover again. They might start feeling more optimistic at that point and put more money in. The problem, though, with this strategy, of course, is that the investors tend to be buying when prices are high and selling when prices are low, which is the opposite of what we want to do. We want to be buying stocks when they're down in price and selling them when they're higher in price. So there's been a number of studies about this emotional investing and really the effects of it. Morningstar is one of the major companies that conducts these studies. Their most recent one, it was called Mind the Gap study from 2023, wanted to try to measure the gap between an investor's actual return compared to whether you just bought and hold a particular investment over time. So this study looked at the previous decade across a number of different asset classes that they're all listed here, and found that on average, investors lost nearly 2%. It was about 1.7% annually each and every year because of poor market timing decisions, because of when they're pulling their money out, when they're contributing their money. It really shows that there's emotional investing going on, and clients or investors are buying and selling at the wrong times. And so you can lose a lot of money. 2% per year is a lot of return given up over a number of years if you're trying to time the markets. And so that might be one reason why investors are looking for professional help, is that a professional advisor can help you keep invested in the market and try to really take advantage of those times when the market drops instead of pulling your money out. Another big reason why participants might struggle with their 401k performance is that they tend to chase past performance. I've talked to a number of participants where they're given a list of their investment options, and this list often includes their historical performance. And so it's very easy, usually, for participants to look at this list and they just look at, well, I don't know what to really pick. What's performed the best? What's done the best historically? Maybe they might be looking at what's done the best over 1 year, maybe over the last 3 or 5 years or 10 years, who knows? But one disclaimer we have to put on all of our slides with performance is it says past performance is not indicative of future results. And there is a reason we have to put that disclaimer on many of these slides. And this study shown here is one of those reasons. It looks at a 5-year period and the top performing mutual funds during that period, the top 25% performers. And then it looks at the subsequent 5 years. So how did those top performers do in the next 5 years? And it shows that it's very difficult to stay at the top. Only 21% of stock funds remained in that top quartile. and only 29% of bond funds remain in that top quartile. So it's very difficult. Many of these funds are actively managed, meaning you have a manager that's trying to beat an index or beat the overall market. And while they can do that over, shorter periods of time, to be able to consistently do that over a long period of time is very difficult, as this study shows. So picking what performed the best historically might not be what's best going forward. And then finally, the third way that many participants often pick their investments is through what's called target date funds. And you might be familiar with these funds. They're often called retirement target date funds. And they're selected here because they're associated with the year that you anticipate retiring. So if you're going to retire, let's just say in 2030, there's usually a fund that says retirement target date 2030. Usually these funds move in about 5-year increments. And the idea behind them is that when you invest in them, they're already allocated to a mixture of stocks and bonds for you. And that can be a positive thing. We'll go through some of the positives and negatives of these funds. But the instant diversification you get from these funds overall tends to be a positive thing. And then, as this graph shows, as you approach retirement, as you get closer and closer to retirement, the amount of stock that's held in these funds declines. So it's automatically going to decline. You as the investor don't have to do anything. It's just the fund manager inside of the fund is lowering that stock exposure, typically buying more bond exposure at that time. So here is a listing of those pros and cons of these target date funds. The pros, again, it is a good way to get diversification. So instead of just picking one or two funds from your overall list, buying one of these target date funds, underneath it, usually you've got several different funds that it owns. It's called a fund of funds. And so you tend to get many different asset classes inside of it. They are also easy to select. So if you have an idea of when you're going to be looking at retiring, if it's in the next few years or if it's way down in the future, you can usually select a date that's close to your retirement period, and it will provide that allocation for you. And then that reduction of risk, that movement of stocks into bonds over time, and as people get closer to retirement, that can make sense for some people. As you get closer to retirement, you might want to reduce your risk and start increasing the stability of your account. However, these funds have some negatives that may make them not the best option for you. The first thing is that they might lack manager diversification. So the fund company that's offering this particular fund, for example, I know Fidelity and T. Rowe Price have a line of these retirement date funds. Well, inside of those funds, it's all going to be Fidelity or T. Rowe Price funds. You're going to get funds from one company. And while they might be very good companies, it is rare that those companies have good funds or the highest rated funds at every single asset class. So it might be better that we found to pick different funds and different asset classes that have performed better. Also, it is smart to pay attention to the expenses that are being paid inside of a 401k account, and these target date funds are no exception. Some of these funds can carry some high expenses. If they're actively managed and trying to beat an index, they can carry some higher expenses compared to more index funds. And so pay attention to how much that these funds are charging. We've also found that while these funds provide good diversification, they may not provide our most preferred asset allocation. And so some of the areas that we like to invest in, whether it's tilting a little bit towards value stocks, or if it's investing a little bit more into small and medium-sized companies, or on the bond side, maybe some more bond diversification and picking up some more higher yielding bonds. There might usually these funds are not allocated exactly how we would prefer them to be. While the automatic reduction in stock exposure over time might fit some people, it might not work out during certain periods. And an example of this would be in 2022 when the market had a very poor year and stocks lost a lot of value. And these target date funds, if you're approaching retirement, some of them automatically at that time reduced and sold stocks, which is poor market timing. In that scenario, you would want to hold on to your stocks and give them enough time for them to recover before selling them. So they can cause some poor market timing decisions. And then finally, overall, it's just very difficult to create a one-size-fits-all solution. So while these target date funds can be good for some people, well, let's just say two people are retiring at the same time and have both selected the same retirement date fund, they might have very different risk profiles. One person might be still able to take quite a bit of risk with their investments. They might have other pensions or other assets to provide the income they need, and they prefer to let their 401k account grow. While another person, they're going to be living very heavily from their 401k investment, so they must reduce their risk further. So it's just very difficult to create a one-size-fits-all solution. Our preference for our clients is that we manage their 401k assets and at least provide that guidance to select from the individual fund options if they are given a decent number of options. So over time, over the last several years, we have tried to provide our clients with some advice regarding their 401ks. But there were some obstacles to this. It was difficult to do this on a wide scale. And here are some of the reasons why it was difficult. First, the participant in the 401k plan would need to provide us with their recent statement that showed their current holdings. And so every single month or every single quarter, whenever we reviewed their 401k, they would need to provide that statement for us. And so it was very time consuming. Also, they would need to provide all the investment options for us. The investment options frequently can change in a plan. And so it would really be up to the client to be responsible for seeing when those changes occur and notifying us. Also, there were some limitations in the software programs that we're using, in that we can conduct an asset allocation analysis for a client, but to be able to do that across many 401k accounts that are all a little different, that all have a little bit different investment options, it was very difficult for us to do that. And then finally, when we would make recommendations, it was also up to the client to be able to implement those recommendations, to be able to go into their account, make the trades. Maybe they would have to contact somebody at their workplace to help them do that. And so also, we really, from a compliance standpoint, we can't log into the client for them. And so we could not make those changes for them either. But now, luckily, there's been some advances in technology that address each of these obstacles. And that is why we're able to really roll out this new service that is a much, much better offering for us to manage retirement plan accounts. First of all, with this new technology, we can connect a client's account so the positions are downloaded every single day. So we're always up to date on what the client holdings are. Second, The investment options, we're always notified through the software program if the investment options change. So again, the client doesn't have to do anything there. We are notified if there's new investments into the plan or if any are removed. This software also makes it very easy for us to see the expenses that are being charged from the investment offerings, called the expense ratio. We can see the more expensive funds, and we can see the cheaper funds, and we can also see the historical returns, and it makes it very easy for us to conduct the due diligence and do the research on each of these investment offerings. One of the bigger things for us is that this new technology also allows us to efficiently manage these recommended asset allocations across many different clients. So for each client, I'll show you an example here in a minute. We can set the recommendation. We can set the recommended strategy. And this notifies us if the client deviates from this strategy, allowing us to make a change. And so we can do this across many different accounts and many different clients. Regardless of the investment options, we can set a customized investment allocation and be notified if a change is necessary. And therefore, we can notify the client if a change is necessary and any recommendations that we're making. And really the magic of this software, I still don't understand fully how they do it, but they're able to partner with each of these 401k providers in order to make the trades. So we can implement the trades for the client, and the client doesn't even have to do that. So it is a very turnkey program, one that resembles very closely our full regular asset management program, where we do everything for the client, from do the research on the investments, make the recommended strategies, and implement the strategy. And the client, we notify them always what's going on, but they really don't have to do much on their end. So I want to show you an example of the three main components here of this software and of the report that you will get if you sign up for the service. And so here on the front page, it'll give you kind of a snapshot of your plan. It'll give the average expense ratio of the funds that you're currently using. It'll also give you a snapshot of the historical returns of the plan. And on the right side, it gives you an overview of your overall strategy of your asset allocation. And then it will follow that with a listing of your investment options. Here, we're just giving a short example, but it will highlight the funds that you're currently invested in, and then also show you the funds that you could be invested in. And it provides a nice summary. I couldn't show any of the performance information here, but it does give you historical performance information. It also gives you the expense information, all just neatly summarized on one page. And then on our end, it also just makes it very easy to click into each of these investment options, and it pulls up some of the research on each of these funds so that we can see their current strategy and their current performance. And then one of the main sections with this report that you'll get is the asset allocation analysis. And this is shown on the report a couple of different ways. The snapshot I'm showing here does it at the asset class level. And so it shows your current percent allocated and the target percent recommended for each asset class. And then it shows how much the variance is. And this is where we get a lot of control from the advisor perspective, is that we can set these thresholds for the variance. And you can even see here where we can click to get alerted if this variance deviates enough from the percent that we have set. And so again, it makes it very easy from our perspective to manage these accounts and get notified if any changes are necessary. So this view is showing it from the asset class level. You'll also get a view that shows it at the specific investment level. So our specific investment recommendations. And then what we do each quarter that you get this report is that we send you a summary of what it says and overall a summary of what trades it's recommending. So we always want to keep you informed. And if you agree with the changes that we're recommending, again, we can do the trades from our side here, and the client doesn't have to do anything. And so this is a summary of the fee that we're charging for this service. It is a flat 0.75% annual fee. And we do ask that the account size be over a $500,000. So there are cases, where there might be exceptions, but generally speaking, our minimum here is 500,000 and above. 0.75% is less than our typical asset management fee. A typical asset management fee might start around 1% annually. And we really reduced it by about 25%. We reduced it because usually in 401k plans, your investment options are more limited. If we're managing another type of account for you, just an individual type of account, we have the whole investment universe usually available to us to pick from. But in a 401k plan, the options tend to be more limited. So we just want to make sure we can provide enough value to our clients still. So we've reduced the fee a little bit from our normal fee. And one thing that is worth noting is that this fee usually cannot be deducted directly from the retirement account. So that is one downside. Of course, it would be very convenient if this fee could just be deducted from the 401k account, for example. But they're not set up to do this. Most plans won't allow it. There are some plans, those that tend to be a little more self-directed, that do allow a fee to be deducted directly from it. So it is worth maybe at least asking your 401k provider if that's possible. But if not, we usually end up having to bill our clients separately for this. They either take the fee from another account that we manage, or we can just send an invoice annually to pay the fee. And so here is an overall summary of the service and what you will get from it. You get a professionally managed account. And it will include asset allocation recommendations. It's also going to include those specific investment recommendations based on the options in your plan and the execution of those trades. And so every single quarter, you're going to get a report, a nice report that summarizes your current holdings, your current expenses, your current returns, that asset allocation analysis, and any recommendations that we're making. And so we know that people are very busy. It's tough to pay attention to your 401ks or to your other investments. You've got many other things to worry about. And that's why we get a number of our clients, is that we can really take that burden away from them and provide that professional management. And now with one of people's major retirement assets, we can do the same thing. So with your 401k account, we can come alongside you and hopefully just give you more peace of mind about it. And we think we can add that value to make sure to help increase the likelihood that that account is going to grow to the value that you need it to grow to once you hit that retirement age. And so I will take any questions that are out there. If anyone has any questions now or otherwise, I'll be happy to answer them at another time as well. In just a second here, I'll put up a slide that shows our contact information. And so you can feel free to reach out to me or reach out to any of our financial planners here if you've got questions about the service. I know we've got some current clients on the call and that might be interested, and also some prospective clients as well that we'd be happy to meet with you. I'm going to go ahead and put that contact information up on the screen here. And so myself, Jason Gunkel, my email address is listed there, jgunkel@onlyworkforyou.com. Feel free to reach out to me directly. Our phone number is listed here as well, 515-225-6000. And our website, onlyworkforyou.com, has a lot of great information on it. You can do some research about our company. And also there's a button on that website to contact us as well. So that was a quick overview of our retirement account management, or RAM service. We're excited about it. We think our clients will be as well. And again, thank you for joining us today, and please reach out with any questions that you have.